Welcome to the People, Property, Place podcast with me, your host, Matthew Watts, founder and managing director of Rockspring. This is a podcast where I share the stories, views, opinions and career journeys of the movers, shakers, innovators and leaders in the real estate industry. Welcome to the People, Property, Place podcast. Today we're joined by Bert Broadhead, co-founder of Alterx Real Estate. Bert has worked for a number of leading firms, from DTZ, now Cushman & Wakefield, as well as Rockspring, which was acquired by Patrizia a few years ago. And he also did a stint with Och-Ziff Capital Management before setting up Alterx in 2014 as a value investor, focused on Western European real estate. Today, the business operates in 3 countries and controls over 2 million square foot of commercial assets and 30,000 residential plots. Bert's also the host of a real estate podcast, Building Our Future, and today is in front of the mic rather than behind it. Bert, welcome to the podcast.
Thank you, Matt. It's a pleasure to be here.
Not at all. Well, look, we'll come on to Alterx and the business that you set up. But a place I always like to start these conversations is, how did you get into real estate, especially you did history at uni?
Yeah. I wish I had a fun answer to this, but the reality is I thought I was doing something slightly different to what everyone else at my university was doing, which was accountancy, law. So I fancy doing something slightly different. Turns out I wasn't being original at all, but that's kind of what it felt like at the time. So yeah, kind of usual waffle of wanting to work with tangible assets and not really having a clue what I was doing. So yes, I'm afraid I've got nothing more original than that.
So history, and then just where did real estate come into the frame? Like, how did you realise, or when did you realise you could make a career out of it?
I suppose kind of final year of university, kind of really thinking, okay, I've got a history degree, I don't really want to study law, what the hell am I going to do for the rest of my life? And actually kind of one of the reasons I got into podcasting down the line was that incredible, I suppose kind of missing spot in the education system where you can learn about all sorts of things, but people are incredibly badly prepared for what lies beyond university. And fine, even if you know a real estate career potentially exists, what the hell does that mean? And even once you've worked in real estate for 10 years, you may not fully understand what that means and the various kind of avenues that could take you down. So yeah, I went in pretty blind, to be honest, speaking to a couple of people who seem to be enjoying themselves, getting a very vague feel for it, a couple of work experience placements where I didn't learn a huge amount and took a leap of faith, kind of not really knowing what I was doing.
And was it a mix of, like, you like the tangible aspect, you like the economics, you like the people, and you just thought actually it's probably quite a good fit from a career perspective for your skills and your interests?
Yeah, and again, I'd love to tell you there was a huge amount of thought behind it, but it was really finding a few people I knew who were in the industry who I liked, doing the work experience, but again, not really understanding really what I was doing, but getting a good feel from people who were out there and the general kind of, I suppose, kind of culture and an approach to work and a starting point, and let's see where it takes me.
And so you went to Cass, did your real estate course?
Yeah, and I think it's changed a bit now, but back then that was seen as pretty much the main pathway into the industry, and by that I mean you were really the exception if you went down a different route. So it was, you became a chartered surveyor, and in order to become a chartered surveyor you had to have a degree, whether it was master's or bachelor's. So it was seen as a kind of conversion course. So I did a 1-year stint at everywhere I've either studied or worked at seems to have changed its name, but it was Cass University. It's something different now.
Yeah, I was going to say that's why I did that intro, because people might not know DTZ.
Go on. Or Rockspring.
Yeah, Rockspring. Go on.
Och-Ziff, go on. Yeah.
Alterx, here to stay. So
well, we started as Alterx, and so even that has changed.
So you've managed to reinvent yourself many times over. So you went to Cass, or Bayes Business School as it is known now, then landed at DTZ. What did that look like, and how did that come about?
Well, so yeah, I actually landed somewhere called Donaldson's, who was a medium-sized surveying practice specialising in retail. So obviously I started in the industrial agency department doing my graduate rotation. What did it look like? It was fun. That's definitely not a work culture that I've experienced since, or possibly even exists any longer. It was very kind of, when did I start? 2006. It was, pre-2008, which I think people who didn't work pre-2008, it's probably quite hard to understand, but I do remember working at the time and wondering, it's like, how on earth does this business actually make money and generate a profit? Because I know I'm not doing anything, and I'm not convinced anyone else is.
Can you shed a light in terms of what your day-to-day looked like, and maybe a window into that time when you were a shed agent? So
it was a good grounding in some ways. So I spent an awful lot of time on the soft side of agency. So we, as a non-retail specialist, someone working in a retail business who wasn't doing retail, it's probably a better way of saying it. We didn't have a big kind of portfolio of clients and stuff to manage. It was kind of trying to hustle for work, and that ranged from some pretty ropey kind of open storage land down outside Heathrow, where you had everyone under the sun trying to rent it to do banquets and even build shopping centres, and you're like, well, hang on, this is a little lock-up piece of land which we're trying to get £2 a square foot for. It was really exciting when you actually won an instruction to let a building, as opposed to a piece of land. So it was really sort of starting from the bottom. But as I say, I quite liked that aspect of not having it handed to you, which is not to say I went and made a huge success of it, but at least I learned about, it was trying to hustle rather than just
being fed work.
Yeah, exactly, being fed the machine.
And so did you rotated and got your letters? And
then Donaldson's got bought by DTZ after my first year. DTZ subsequently became Cushman, but not for a few years thereafter. So then I did a stint in valuations. So kind of during the crash, I was in Vals, just watching it all play out.
In terms of that time, were you quite fearful of like your job? You probably saw quite a lot of people getting the boot. It's really quite a difficult time to get a role as well. Were you quite pleased to have been in a valuation seat, albeit probably quite a difficult time in terms of just marking down all the values every month or every quarter?
Not really. And I suppose that came from a couple of places. So actually still keep in touch with the guys who I did my valuation placement with. So I was incredibly grateful for the experience, but I always saw it as, it was a rotation rather than a final spot. And the great thing about being a graduate, particularly back in those days, is there's no way down. So the fear of kind of losing out wasn't particularly noticeable. I was pretty confident that even if the good times would come back, and I'd find my way, whatever that was.
So after a couple of years, you must have a much better understanding of like real estate, the different facets of it, and where you could kind of take your career. What was the reason behind leaving advisory and agency world to kind of move to the principal side?
Yeah, I'd say kind of quite early doors, I was kind of itching to get out of the agency side, and probably comes from like two elements. One of which was is that I wanted to be in that kind of decision-making role and ultimately shaping the physical asset and just getting that bit closer to it. And the second bit is culture is probably the right way to say it, that I get incredibly frustrated in those bigger working environments when politics comes into play, and that it's just a huge kind of demotivator for me. So I wanted to be somewhere kind of smaller, nimble, and slightly more kind of meritocratic.
And so how did like Rockspring come about? And from a skill set perspective, I'm assuming you had to be quite strong from a financial and numeric base, or
No, so I'd say Rockspring was perfect for me at the time in terms of they were trying to transition from, if anyone listens to this who was at Rockspring, they'll probably give me a dead on next one I'm saying, but from a kind of more traditional institutional fund manager to they'd raised some kind of value add style funds, so it was kind of bridging that gap into more of a what became the kind of private equity model. And as a result, had a kind of blend of people across traditional surveying backgrounds, and we're kind of pushing more into, again, what became the kind of PE character set. And I was probably quite lucky in terms of I did quite a lot of work outside of Vals in the free time, kind of doing all sorts of qualifications, which I can't remember what they were now. Kaya, Chartered Alternative Investment Analyst, just trying to get my DCF skills and all that up. So I was trying to pitch myself as being a bit more financially literate than I probably was, and they gave me a chance. So that worked out.
Yeah, I guess you'd be competing against people from banking or other private equity businesses, or already on the principal side.
Yeah, Rockspring was always very, and I think probably still is, as Patrizia, kind of committed to having that real estate first kind of perspective when they were looking at people. So banking was kind of less of a prerequisite, but it was certainly probably people who'd done more investment focused roles than my background, which was leasing and valuations, albeit, it was only 2 years into the job very early on in my career.
So you landed at Rockspring. What kind of projects were you working on, and what was the role and remit?
Yeah, that was the fun thing about it. So we were, soon after I joined, a good friend who was a cast with me on my conversion course and has latterly started up Firethorn. So he got on board, which was A, fun, and then B, there was all sorts of fun things going on. So they just raised a closed-ended value-add UK fund, which was being invested. Rockspring had secured MPS, kind of Korean pension service. It was kind of first time them coming into Europe and doing some big deals for them, and latterly getting involved on a separate account for them, investing it across Europe. And then also kind of seeing how the more traditional parts of the business, so looking after the pension fund, segregated mandates, etc., was all kind of working. So you got really good broad exposure across the business, and I think that was the first time I kind of saw the culture that I wanted to work with, in terms of see a problem, see an opportunity, put your hand up and get cracking, and that's kind of been the way I've worked since, and the environment that I kind of enjoy working in.
So you were working quite closely with Chris Webb, were you, just on UK or European transactions?
What I say working closely with, he was a counterpart, so doing similar things to me, albeit we weren't normally doing the same thing.
And so were you more UK focused, or was it more European at this stage?
It was pretty much 50-50. So yeah, I can't remember how long I spent at Rockspring, 5 years, but probably with a kind of broad 50-50 split between UK and rest of Europe.
And so you were underwriting deals, transacting, structuring them, involved with putting the business plans together and executing the value add. Also all parts of that kind of investment life cycle. Yeah,
very much so. But as a junior, so on a transaction there'd always be someone more senior, but certainly running with numbers, putting the investment memos together, and then as you got more senior, you got more responsibility, and it all grew. But the fun thing about it was it was always evolving. It very rarely felt like you were pigeonholed in one particular thing, and therefore it's quite hard to kind of tell you exactly what I did, because it was all a growing business and a kind of evolving role, which was the bit that made it fun.
And so you did about 5 years, like you said there. What was the rationale behind leaving, and why did you decide to leave and go to Och-Ziff?
Yeah, I think everything just kind of runs its course, and that was at a time when back then was called kind of opportunistic real estate investors, and PE was probably at its kind of peak, and people seemed to be doing all this kind of high octane thrilling stuff, and I felt like that was just a piece of my career, or a piece of my understanding that was missing. And particularly in investing, Rockspring was nearly all just direct investments, so investing into the assets, looking slightly more at investing in businesses. That's kind of what I wanted to do. Och-Ziff had done some really interesting stuff at the time, so they had backed Nick Leslau and a GP for Max Property, which is obviously a very successful deal. That was ongoing at the time. They put a load of Mesdat on Venido takeout for Roundhill going in, taking Blackstone out of that in terms of student property. So it was kind of fun. It was different. It was a kind of slightly different skill set. So good learning opportunity.
So what, it's just like a higher risk level, or was it more like intellectually challenging?
Yeah, just a different intellectual challenge. Just seeing, just going away from that direct investment, focused on the equity, albeit using debt, and just going to somewhere where the parameters were slightly broader, and in theory you had the kind of freedom to do what you wanted.
So more flexible capital to try and drive some higher returns. You were there for about a year or so before you decided to leave and set up a business.
Yes.
That is the case, isn't it?
Yeah.
So what was for you at that stage? You clearly, your career had gone from surveying to the principal side at Rockspring, to then taking another step up in terms of more opportunistic aspect. I guess going one step further, setting up your next business was the next high. What was the reason for deciding to set up your own business, and why did you decide to do that?
So I should probably clarify. It wasn't just kind of by myself. There was two at the time senior partners in the business. So for me, it was a kind of a de-risk position, let's say. So you saw it as getting the benefits of the kind of freedom and excitement of doing something by yourself, but with the safety net of two senior people who knew what they were doing, had helped already kind of put some of the funding in place. So it seemed to be this kind of ideal position. One of the people My now business partner was the person who had recruited me when I was at Rockspring, or going into Rockspring. So there was that kind of continuity as well, and trust. So yeah, from that perspective, it was a bit of a no-brainer, really.
You put it as a de-risking. Some people would look at it as a risky move, leaving a safe environment to move to a brand new startup. Can you just talk me through like the business model and the cash and the business plan that you were looking to kind of work on?
So I mean, it has evolved. So we started as a pan-European private equity business, predominantly with a single LP to begin with, and we made investments in Germany, Austria, Portugal, UK, and then as life went on and the markets have evolved, trying to identify that kind of macro opportunity has become increasingly difficult, particularly with a small team, and maintaining a small team was important to us. We didn't want to get too big. So over time, we've become UK focused, much more asset specific and less private equity. So we do stuff on balance sheet, and we bridge a kind of funny gap between being a GP and managing other people's money, but also doing some of the operating and owning the operating businesses. And we sit in a kind of slightly weird patch, quite hard to define.
So initially you had a single LP. How did that come about, and how do you go about choosing an LP and structuring that agreement and having a plan, especially as you said it had quite a wide remit as well?
So to be completely honest, I had very little to do that. That was my kind of then senior partners in the business, and we had all had a plan about what we wanted to achieve. And part of the business, which still remains, is that part of the carried interest, or essentially your kind of GP profits that you make out of a business, would go to a charitable foundation or a cause. So we wanted to make sure that, as opposed to the existing PE model where you saw a lot of people monetizing the AUM rather than the kind of alpha generation, which seemed to be kind of massively counterintuitive. We wanted to try and create a structure where actually the incentivization was entirely on the upside, so the alignment was much stronger with the LPs. So rather than kind of getting rich off management fees, it was really, if we all make money, then we all share that. But if we don't, we're not going to get rich by just kind of growing the asset base and selling the business kind of off the back of your trust and your capital. So that was very much the theory and the hook, and that led to a kind of fortuitous conversation somewhere out in America, facilitated bizarrely by a Harvard professor at the time, and it kind of went from that.
It's interesting just from an AUM and fee perspective, because quite a lot of businesses now in this current landscape with asset values dropping, their kind of obviously income is predicated on the value of those assets, and they're taking 20-30% hits on their fees. Can you just expand on that alignment piece further, and why you didn't want to get, someone listening to this who might not have their head fully around the different types of business models? Can you just expand on that asset management, that fee piece compared to the alignment and that longer term?
Yeah, so the misalignment and as I say, it's made slightly different, but I think the fact that PE has changed, and we're kind of looking at a new landscape now. But certainly if you go back 10 years to how it began, PE was all about, took a management fee on the assets you managed, but the idea was always really that would kind of cover overheads. And then where PE managers get rich is you have a carried interest. So there's normally a hurdle. So let's say you make 8% for your investors. Anything over that is split according to a kind of pre-agreed waterfall, but let's call it 20 to the GP or the manager and 80% to the LP or the investor. The problems became where, if people were charging a 2% asset management fee, if you've got 5 billion under management, you're suddenly making a hell of a lot of money just through income. So it didn't really matter if you didn't make your outperformance, especially when, let's say, kind of extraneous investors or external investors were starting to look at these private equity businesses and go, look, you've got an amazing amount of recurring fee revenue. So if you put 10x on your recurring income, it starts becoming a massive kind of value for the business. So the managers are all going, okay, well, let's sell the business and getting rich off essentially the management fees rather than the performance fees. So the guys who actually invested in the funds are like, okay, well, you've made a load of business off, or a load of money off the recurring fees I've been paying essentially just to kind of keep the thing running. Where's my performance? Which isn't to say some of them didn't perform, some of them did, but the alignment got wrong.
Because these PE businesses was doing deals to boost their AUM or paying over the odds for assets, that actually they couldn't execute the business plan.
No, I don't think it needs to even be that cynical. It's just an alignment thing, and you can see through it include Rockspring in this when they sold to Patricia, but there are very few mid cap real estate PE firms that in fact I'd struggle to remain one. They've all sold, and why not? They were given these enormous valuations, but the valuations were derived from the recurring income, predominantly not from the carried interest.
So when you set Alterx up, or when the business was set up, you decided to be much more closely aligned, and rather than it be predicated on fee income and a multiple that you could potentially get from that, it was more about your actual performance and selecting the right deal, doing the right thing, and capturing some of the upside.
Yeah, that was the intention. But look, it's easy to sit here and be incredibly idealistic, but you've also, there's all sorts of tensions in terms of you've got to pay staff, you've got to figure out how to get money for, kind of regular bonuses rather than just you can get a piece of the pie as and when it comes to fruition. So I'm not sitting here saying everyone's got the model wrong and I've got the perfect solution. Far from that, and we were naive in all sorts of things. But that was the intention in the sale 7 years ago when we started. I kind of alluded to the fact that I actually think that with that mid cap PE market essentially gone, large PE now has become so big that it's almost not PE anymore. It's this new kind of breed of multi-manager and people investing money up and down the capital stack and up and down the risk curve. So the game's kind of changed anyway. So that kind of point of difference is almost kind of redundant in any case.
So you took the business from having quite a wide remit in terms of flexibility, in terms of the types of deal and where you can invest. Can you just talk to me about zooming in and having a little bit more focus, and why having focus has been beneficial?
Yeah, so one of the things that we remain is value investing is our focus. So we're trying to find obviously value rather than growth opportunities. And certainly when we started, there were still pockets of value. So Lisbon was one, and we got involved there in both retail and residential. And it was a macro thesis that this city has a long way to go, and it's not being reflected in the real estate values. So investing in there was essentially just a proxy for riding that wave. When that moved, and that moved really quickly, I'd struggle to kind of argue that there's been a really great value macro play since then. Now, people have made a lot of money in industrials across Europe and in the UK, but it's almost kind of, it's definitely a growth play. It's there's hard to argue that was value in hindsight. So yeah, value's kind of almost moved in this capital cycle away from asset pricing into operations, and people becoming deep real estate subsector specialists. So it's getting increasingly hard to talk about what I was used to when I started as a surveyor, office, retail, industrial. And that was it. People didn't even invest in residential. Now, obviously, you got residential, but people wouldn't talk about just resi. It's all the subsectors. What are you doing? Single family, multifamily, social housing. You're doing building for charities. There's all sorts. It goes on and on. And having a deep rooted specialism in one of those is now the kind of window into value as it stands, and I'm sure that will kind of rotate again, but that's where we're at the moment.
How would you define value investing? What do you mean by that specifically, rather than growth? So term which comes from outside real estate, and Warren Buffett is the ultimate value investor. So you're looking at fundamental mispricings, or trying to identify fundamental mispricings, whereas growth, as it implies, you're looking for things where you think you're probably buying the market, but the growth is going to come through on rents or whatever it may be. So can you just talk to me about your thesis and how you landed on the value in the space that you operate now, and then can you elaborate a little bit on that space and where you've identified value?
Yeah, sure. So we have currently focused really on the wider residential sector in the UK. Why? Because the structural supply-demand imbalance remains hugely skewed towards being just a kind of almost unmatchable structural undersupply, and that's always a sensible starting point. You've then got a couple of interesting market dynamics, so a kind of quasi-monopoly of house builders, and all sorts of kind of political wranglings about how to deliver more homes. So that environment is an interesting one to go into. And then within that, there are all sorts of, I suppose, kind of stimuli or kind of catalysts for change. So modular housing is something which, you know, is on kind of everyone's agenda, but and covers all sorts of different products, but definitely has scope for change, and change is exciting to us. Build to rent, so again, you know, that started kind of in the UK really 10 years ago, was all multifamily, so flats to begin with. Single family has to happen. Right now, quite difficult to make work from the pricing perspective, but the big players are leading the way, and that will kick off and grow. And again, affordable housing is another one where we have to deliver more affordable. The traditional registered providers and housing associations are under their own form of financial pressure. So there's going to need to be more avenues for bringing this housing product forward. So we have interests in a land promotion business which specialises in helping landowners get planning consent. So through that, we're working on, I think it's about 45,000 potential plots across the UK at the moment. We own on our balance sheet an SME house builder based outside of Northampton, where we're bringing forward in a 50-50 JV with another regional house builder, one of the kind of exemplar garden villages in England at the moment. So kind of really high quality urban space, shared amenity, etc. And most recently, we've bought a for-profit registered provider to start accessing the affordable housing space and see what we can do to help improve and deliver more affordable housing in that subsector.
So do all three complement each other, or are they slightly separate just in terms of their remits?
So they're all separate and they're all funded differently, but there is clearly commonality in us as an owner of or a manager in some way, shape or form. So how we maximise the kind of interrelativity between the three while keeping it at arm's length is part of the opportunity.
And you mentioned they're financed differently. How are they structured from a financial perspective? I mean, you mentioned you had a kind of an LP originally at the start of the business. You mentioned you owned something on the balance sheet, the house builder, and then the other two. Can you just explain maybe the structures or the economics behind that?
Yes, so you know, it just comes back to our origins as a PE business to begin with, so that they are held in funds essentially, but our what differentiates us is we have a very small LP base, and we normally have a very flexible that allows us to have a very flexible kind of structure behind it. So we have always tried to establish small funds, so in some instances it might just own one asset, might own two assets, and make sure that fund duration is matching the business plan. So it's not just, I've got a 5-year fund with a couple of years extensions, what can I find? It's like, well, we've got a business here which is going to produce value possibly over 3 years, but possibly over 10 or 15, and let's find the capital to match that.
And is that quite hard to find capital that matches that? Because I guess, as you kind of alluded to there, you know, taking a 3-5 year business plan, trying to force the market and trying to force a return within that period can be challenging. I mean, you can do it and can do it very well, but also can massively mess.
Yeah, so I suppose you have to be a bit more precise than that, and it's here is a business plan, and we are what we're trying to achieve is returns to the investors within X years, but we also need to be cognizant that particularly in our planning business, planning can take a long time, and everyone needs to go in eyes wide open, and us as managers, we need to be able to make sure we can underwrite like what happens if the duration is a lot longer than we anticipated. Can we still deliver attractive risk-adjusted returns back to our investors, and can we make sure that the structure kind of not necessarily, I suppose foresees. That's not what we want to happen. We've got to be able to adapt and make sure we can live with that kind of downside position.
Does that reduce your capital base of where you can go and raise capital from, or does it make it easier?
Yeah, so our capital raising has always been done ever since we set up really on a ad hoc's probably unfair, but it's a kind of preferred partner basis. So you meet people as you go on, you maintain the relationship, an idea comes about, and you're kind of talking it through. We've never gone to the market and actively fundraised or appointed someone to do that on our behalf. So
the value of the relationships and the network and everything that you've built over the years.
Yeah, and like anything, some come to nothing, some the timing's just wrong, and it's matching, having that bit of fortune, that idea, conversation, relationship, everything kind of aligns at that particular moment.
So can you just tell me about your role in the business, and then maybe your business partner's role in the business, and how you maybe slice and dice that?
So I suppose I have moved, not exclusively, but more into a kind of systems process manager, and making sure, particularly in the businesses we own, that boards are set up right, that we've got an ESG strategy, what the investment strategy for the sub business is, how we're going to go about executing it, what staff we need, that kind of strategic insight, whereas my business partners focus predominantly on the capital side and the deal side.
Can you just talk to me about Cora as a business? Because I know you employ 70 people within that.
Yeah, I'm not sure it's quite that much, but it's about 50. But so Cora is a smallish house builder, so we will build about 150 homes this year and hopefully 300 next year. And it's been going for 10 years, but we rebranded as Cora last year, really to try and set the tone for what we're trying to do, which is create a house building business with a clear purpose of building kind of homes for the future. So trying to move away from the public perception of anyone over a mid-sized developer just being a box basher, and putting some real thought into not just the aesthetics of what we're trying to deliver, but also the sustainability of it, and trying to create a culture as a developer of someone who's trying to meet at least some element of societal need where we're developing. And hopefully have that reflected in the fact that when you go for planning applications, we try and get some support rather than just letters of objection. So we're just again, it's luckily quite a low bar in the house building sector. So we're starting from a solid base and just trying to push boundaries where we can.
And is the plan for that business to build the houses and then exit them, or is it to kind of manage them and build like a single family rental business, which obviously is pretty in vogue at the moment, or there's a lot of capital chasing it?
Cora is very much a developer, so we'll certainly partner with people and are partnering with people who want to own the end product. But our role as a builder is that development side, not the owning manager.
Yeah, what's the biggest opportunity in the residential space that you see?
It's a difficult one. If you are up in the supply chain, certainly the off-site manufacturing element is massive. And I know when majority of people hear that, they're thinking about kind of volumetric houses on the back of lorries. And there are a couple of guys who, top hat ilkers, are doing a fantastic job of that, and a lot of others who've fallen by the wayside. But off-site goes well beyond that to panelized brick systems where you're not getting a house delivered, you're getting the walls, and then you're essentially kind of building the house up, but you still need all your own kind of wet trades, electricians, etc., delivering the end product. And then you can get roofs modularly manufactured. So it's trying to find the right blend for certainly from Cora's perspective, is how can you utilize the technologies out there but not lose your kind of individual touch.
Yeah, I guess it's trying to improve the process and the systems and automation aspect, but without losing or just becoming like everyone else who's adopting it. It's putting your own spin on it.
And look, there's so many houses in the country that need to be built, again, across a huge value range. And as nice as it would be to sit here and say that all housing in Britain's got to be designed to an incredibly high standard, we need to build minimum. I mean, the stated target before they got rid of targets was 300,000 a year, but that's seen as being on the low side of the new estimate, which is probably north of 400,000 homes a year. That's a new city every year, and it's incredibly hard. The challenge for people to master plan the developments and then create quality product. We've got to do it. You can't just shy away from it, but I think people underestimate just quite what a challenge that is.
I guess does that lead you on to the placemaking aspect in terms of that part of your business, and can you just expand on that as a project and your view and how you go about delivering a massive scheme like that?
Yeah, so our scheme up in just outside Leicester, Broadneck, is a new garden village, 2,000 homes, 500,000 square foot of employment land, town centre, and then vast swathes of parkland and sports fields and all of this. So how do you get about doing it? It's been a learning experience, and it needs, the one thing I'd say is it needs an enormous team and a lot of patience. There's a lot of moving parts, and you know that comes back to we're in conjunction with our partner going to be building 2,000 homes, and by introducing new tenures to the site, so build to rent and other ideas like that, we're looking to accelerate delivery as much as we possibly can. But even with that in mind, like if we build that site in 5-6 years, we'll be doing unbelievably well. And that just kind of shows you, as you know, it's 2,000 homes, 5 years in the context of 400,000. It's drop in the ocean, and this is a new settlement we're building.
It's huge. I guess how do you balance that? How do you have that long-term vision, and how difficult is it to create a place, a destination, a community with all the different facets that people would expect?
So I mean, difficult, but it comes back to having a really quality internal team, but making sure your consultants high quality, because it all starts with a design, making sure that you're building something, hopefully innovative, but you're really understanding the local needs, so that the design is fulfilling a purpose rather than just being kind of what you think might be good on paper. So the design is clearly one thing, but then you've got to deliver it, and you've got to make sure that design, that the key elements of it are not kind of watered down throughout the build-out process and, you know, value engineered out. That you got to kind of keep hold of that central beliefs, and ultimately you got to have the belief, which I do have, which is that great places, well delivered, will deliver you as an investor better returns, and that you will be able to prove out higher rents if you're doing BTR, higher sale values if you're doing for sale, by creating a really awesome sense of place.
Has it been a difficult period balancing inflation and build costs, or how have you been able to manage that over the last year or so? Yeah,
build costs, particularly in residential, and I assume in other sectors, but speaking from resi, have really kicked in since the end of COVID. So they started earlier and hopefully kind of flattening out a little bit sooner than the rest of the curve as well. So it's really difficult, and you know, buying land at the moment, there's planning consents are few and far between, and you've probably been reading in the paper that we're expecting a housing delivery to almost half this year, which, you know, is largely driven by the difficulty in getting planning consent. Now, what that means is that the price of consented land has rocketed up. At the same time, you've got, you know, big agencies predicting house prices to fall by up to 20%, and you've got your build costs going through the roof. So that's a really hard market in which to try and buy consented land prudently, without making some pretty big assumptions. So we are kind of work around that has always been that we've got a pretty strong land bank, but you have to use that word carefully. So that's not land we're just sitting on. That is land which we're promoting through the system. So currently it doesn't have planning permission, but if you're promoting enough of it, you're hoping that at least part of your kind of required build out each year is coming from sites that you at least control, and then you can buy at a discounted price from the market. So that de-risks it a little bit, but yeah, buying land is difficult, and you know, the house building sector is strange and you know, partly monopolistic in terms of big developers have far greater access to cheaper debt and capital, and buying land is easier for them.
Well, they've got a bigger bank or have banked it for longer periods of time.
Yeah. They've nearly always got bigger or longer housing land supplies, but access to capital is a huge one for small developers.
Can you talk to me about where ESG fits into the kind of the house building space? Because there's a lot of noise, obviously, at the moment, and rightly so, about ESG. Obviously, a lot on the E, and maybe a bit more focus now on the S side. Where and how do you see it, and where does it fit into your business?
Yeah, crikey, that's almost a conversation by itself, Matt. But it's critical, and so the E bit, fine, is probably the most focused on, because in some ways it's the most measurable, and there are a lot of new tools out there to try and measure social value. And I suppose my kind of main lesson on this journey is all of this stuff you can be incredibly cynical about, because frankly it can nearly all be gamed. But you almost have to step back from that and say, look, what are we trying to achieve here? And that is ultimately lowering our emissions, helping people lower their emissions, creating a kind of community. These are all good things. And frankly, if there's some way of measuring them, even if they're imperfect, as long as you can apply the imperfectness consistently and show the trend, that's the most important thing to us. And it's not necessarily ticking any boxes. It's being able to demonstrate to all of our stakeholders that this is something we're thinking about, there's something we're kind of trying really hard to try and help solve, and we are tracking it in a consistent way.
Yeah, without, I guess, a framework to be able to quantify it easier, it's pretty challenging.
You got to have a framework, and luckily there are all sorts of kind of third-party external ones, which it's kind of, you've got to choose the one that's most appropriate to you, and then stick to it.
Can you talk to me about, I guess, the third part of the business, which is the RP business? Why did you buy an RP business? What is an RP business, and where does it fit in terms of Alterx?
Yeah, essentially, so to own or manage affordable housing in the UK, you need to be a registered provider, and probably 15 years or so ago there was legislatory change that you could be a for-profit registered provider. And there have been, I think there are about 50 registered for-profit RPs at the moment, but the two of note are Sage, which is Blackstone backed, and L&G have got involved and done a really good job as well. And why did we get into it? So affordable housing can offer not particularly sexy, but low, stable, inflation-adjusted returns. We need to deliver an awful lot more of it. People are getting increasingly priced out of market housing. We're well positioned with our land business and Cora to kind of try and help facilitate that. So in some ways it was a kind of an obvious play. And there are also all sorts of kind of interesting products emerging from within the wider affordable sector to try and kind of help bridge this viability gap, I suppose. So shared ownership is the largest one that people have heard about. Still kind of pretty poorly understood by particularly banks and also a lot of investors, but we think that's a pretty interesting product in terms of offering people a sound kind of foot onto the housing ladder, but also offering investors an interesting product as well.
And in terms of that value, you see real value, but also growth in that particular market as well.
Yeah, so I think growth will come through both the kind of operating platform and having that specialism in the sector, and being able to kind of really set yourself up as not just a good manager of people's money, but a good manager and kind of trustee custodian of ultimately your tenants and your shared owners as well. So you're acting in kind of an interesting kind of fulcrum point where you've got responsibilities on both sides, and you have a specially regulated board, and you're subject to, quite rightly, a high set of standards that you got to act to.
As we sit here in middle of May, cast our eyes forward to the end of 2023 and 2024. What are you most excited about, and what's your vision for the next 6 months or so?
So yeah, from an Alterx perspective, is knuckling down on the RP and making sure we get that up and running. This time next year, we'll have our first houses coming out at Broadneck. They're going to look fantastic, and a lot of the landscaping will be done. And I'm really excited about that, because I think just being able to show that you don't have to be Poundbury and King Charles as he now is to deliver a really high quality garden village, and that kind of design and everything can lead to good financial returns as well. So from my perspective, that's interesting. And I think from an industry perspective, there's also, it's the most interesting it's been for 15 years. You've got kind of, questions over the future of the office, what that's going to look like. Retail kind of seems to have reached its nadir, and so now, great, okay, we've taken the pain. What's the future, and where does that go? And it does town centre just equal retail, or is there kind of something more interesting we can do? Life sciences will continue to do all sorts of stuff I don't understand, and data centres will get bigger. So we're at this, I think, great moment where there's all sorts of innovation and trends and things which are about to click into place.
And I guess also from an Alterx perspective, can you still take advantage of some of those additional trends outside of residential if you wanted to pursue them, and if there was enough value there?
100%, and we've dallied in technology before, and we'll continue to do so. But you've got to maintain focus as well, and trying to do too much normally just results in doing everything badly. So if you want to stay kind of, I say lean and thin, but I'm on camera here, so I can't really get away with that. But if you want to keep the machine trim, you can't do everything. So that's the trade-off, and that's the discipline is keep your focus.
Can you just talk to me about some of your learnings about building a high-performing team, and then maybe some things that haven't gone so well when hiring, or your learnings from building a business from a people perspective?
Yeah, so my number one learning has been trying to teach yourself to manage people and get the best out of them. And that's an ongoing job. And that's something particularly in real estate that you're never taught. So if you're lucky and you work for a really good manager, you might pick up through kind of almost osmosis, just the key assets. But that's a challenge, is when you realize that it's not school anymore. A bit of kind of leading from the front and hoping everyone's going to just follow suit will be enough. Like, no, you got to think about this and work out how to try and get the best out of people. And that comes from, I say it as if I'm really good at it, I'm not, but that what I have done well has come from a combination of reading and speaking to people, and just taking the time and trying to take a slightly more disciplined approach to hands-on management. And that's really come about through, I suppose, a couple of early examples of hiring, particularly when you're in a small team, and probably expectations are slightly misaligned, but also, when you can look back and put your hands up and go, look, my management was insufficiently strong. So if you allow problems to build up rather than kind of just quickly check, the more regularly you're checking in and talking, clearly the less likely things are to kind of build up and get unresolved. That's obvious, isn't it?
Yeah, so learning, right? I think I can definitely relate to some of what you've just spoken about, because you can read stuff and you can be told things, but then when it comes to actually practically working, not everyone is as intrinsically motivated and driven, especially by the same things as maybe you. And it's just trying to wear those different hats and understand what people's drivers are and help them along their particular journey as well.
Yeah, no, I think the other lesson is it's really important not to confuse being entrepreneurial with being haphazard. So if you want to be entrepreneurial and successful, you need structure, and you need, there's little enough structure as it is. So you've got to grab it and say, look, okay, fine, no one likes meetings, but we're doing this Monday meeting and we're doing it this way, in a way that I've really clearly thought about. So we're going to get the most out of everyone's time. We're going to get the most kind of accountability up and down the business and across people, know what we're each doing, and make sure we can hold each other to account.
You're about to be a father for the third time?
Yes.
You've got 2 boys already?
Yes.
How do you juggle husband, dad, entrepreneur, businessman, manager? How do you juggle all of that? And how do you work across family but also business?
We give up podcasting and gym. So obesity gradually gets its claws into you, which is obviously a brilliant bonus. Again, look, it's a bit like managing people. I wish I had the answers. It's an ongoing battle of just kind of trying to balance all your priorities. But that's sadly that's just life, isn't it?
As we draw to a close, then, but a question I ask everyone who comes on the podcast is: if I was to give you £500 million worth of equity, who are the people, what property, and which place would you look to deploy that capital?
People, if I say anyone other than my existing team.
You can, of course, you can have your existing team. Of course you can.
People's the most difficult bit, and the asset's easy. So I would stick to residential at the moment. It's what I know. The opportunity there is massive. Just got to get involved. And what was the last bit? I'm still a big buyer of the UK, and I know we've got all sorts of problems. But again, it comes down to specialism, macro understanding, and I've invested across Europe. But you just got to, the world has changed just to becoming, you've got to really, really understand the microdynamics and be an expert. And I'm only ever going to be an expert in the UK, probably just England, could probably narrow that down. So you're stuck with me.
Your team, the UK, and the living market. Something we didn't speak about, but you mentioned is the podcast. Can you just talk about your podcast, why you set it up, and a little bit of insight to why you decided to do that?
Yeah, no, so the podcast, I can't remember when I set it up, 5 years ago maybe. And So my little sister has a cooking podcast, which was, and still is, far more successful than anything I would ever endeavour to do. But I was amazed by, starting from kind of zero background, she was getting really high profile guests on. So how are you doing that? So I just call them up and ask. So I just thought, well, actually, that's a pretty interesting way when we were still kind of looking for investment ideas of just trying to get kind of interesting people almost to come to me. So that was part of the idea. The other part was going back to what I was talking about when I was at university, is like, can I just start trying to create a bit of a library of thoughts for people who might be thinking about a career in real estate but not have a clue what that actually might entail. So there's an awful lot of news available in real estate, and there's an awful lot of what we might call kind of self-propaganda, but there's very little of just kind of ideas. Let's put everything else aside and just talk about like just concepts in real estate. So it's just trying to get experts on whatever, various things, from a couple of technologies to people who design cities, people who are thinking about sustainability in a different way, kind of anything and everything. People with interesting ideas, and to get them on and talk through it and just see what came of it, really.
Maybe you should start it up again when the safe arrival of your third
child
thanks, Matt.
Arrives. We can come on. We'll
maybe this will be the catalyst to get you back in the podcast.
That's been fun. Thank you.
Well, Bert, thank you so much for joining me. I've really appreciated it, and excited to see what you and the team go on to do back end of 2023 and beyond.
Thank you very much. It's been a pleasure.
Thanks for listening to this episode of the People, Property, Place podcast. If you found it insightful, feel free to share it with a friend or colleague, subscribe, give us a rating, like or comment. It helps tremendously. It'd be great to hear from you on LinkedIn. I'm super open-minded to recommendations of which guests you think we should get on the podcast or areas of the market that we should explore further. So do drop me a message. The People, Property, Place podcast is powered by Rockspring. The team recruit experienced talent for real estate private equity firms, investment managers, REITs, property companies and advisory firms across the investment, asset management, development, fund management, ESG, cap markets, investor relations and general practice space. So if you're considering your career options at the moment or looking to attract top talent to come and work for you, head over to the website www.rockborn.com, where you can find a wealth of resource to aid your search. Have a great day wherever you are, and I look forward to catching you next time.